Hello, everyone. This is Donna Bauer, the original note buyer, and I am real excited to bring to you two very special guests that I think you're going to find to be very interesting and very enlightening. Today I have with us Mark Stein and Terry Lewis, both of Seller Finance Consultants, and we are going to delve into the Dodd-Frank issues that I know are plaguing so many of you. Terry and Mark, are you with me?
We're here.
Hi, Donna.
Awesome, awesome. Well, I got to tell you what a pleasure it has been to meet you. I've heard you speak at the different events, and I know that it's a hot topic and everybody's flocking to you. And so I especially appreciate your taking time out of your busy schedule to do this recording for the benefit of my clients and my students. Why don't you start by, let's talk about how did you wind up getting into this? It's such a specialized field.
Well, Donna, Terry Lewis here, and Mark and I met after Noteworthy 2 years ago, and he approached me with after I had, Jack Sternberg had called me out in one of the meetings and said that I was kind of on the forefront of this Dodd-Frank thing, and no one really knew about it, no one was talking about it. But I had talked to Jack about it the year before, having read the Dodd-Frank Act, which is really boring and puts you to sleep, and then I've probably read it 4 times now. And the S.A.F.E Act, I've been in the real estate mortgage business since the early 80s. I remember my grandmother had notes, and that was how she lived off of her passive income by doing notes and actually buying notes from people, and it was a really important part of her life. So fast forward, my wife and I owned a mortgage company since '97, and in 2008 we closed it down because of the Dodd-Frank Act. We were just a little mom-and-pop operation in La Jolla, California, and was really seeing a big change, a shift in the whole marketplace. And after having read this and all the confusion in it, just saw that there was going to be some big things coming up. And actually the Dodd-Frank Act created our business model, unfortunately.
I agree with that. But I have to tell you, I mean, Dodd-Frank has been a nightmare in my opinion. I think it has done a lot of harm with seller financing as far as it keeps people from doing what would have been great deals. But on the other hand, I do like the fact that all the people that were just throwing things together haphazardly now have to comply. So somewhere there's a balance. There's good and bad from Dodd-Frank. But I am thrilled that now you are offering a way that people can be assured that their transactions are Dodd-Frank compliant. Do you want to tell a little bit about Seller Finance Consultants and what you offer, so that way people will understand the perspective that you're coming from, and then we can get into some of the details about
Sure.
Dodd-Frank and that kind of thing.
Yes, that'd be great. So what was created from the S.A.F.E Act and the Dodd-Frank Act was a national mortgage originators, for lack of a better word, registry. And so everyone has to be licensed on a higher level now. And everybody, it's a federal law. It's organized by the states. So what we've done as Seller Finance Consultants is we've become a national mortgage loan originator, and where we can be licensed by the individual states based on what their requirements are, and we can underwrite or bless these seller finance transactions that are required by the federal law. And it's like creating a loan like a bank would create a loan, only the seller financing part of it, where you used to just have to go to escrow or and do this. It has some laws behind it now and some standardization. And what's missing right now is the standardization part, where We're really excited as seller finance consultants to be working with you, Donna, and also with some attorneys in the nation, creating a standardized note and loan package that will create the maximum value for a note in anywhere in any state, and that is really what our goal is to accomplish here in 2015.
Which is totally, totally awesome. So for all of these notes that I have said they're not our target market, you know, and I'm referring to those notes where someone buys a pool of REOs. They've got 50 REOs, they rehab them, they turn around and sell them with seller financing, and you try to sell those notes to an institution, the institutions don't want them. And because they're afraid, you know, was that person, was he Dodd-Frank compliant?
Right.
So now we could say that if that person would come to seller finance consultants and use your MLOs in each state and would underwrite those loans through seller finance consultants, my goodness, I got private investors that would jump on those all day long.
Right.
Well,
that's the name of the game is you know, all this talk of exemptions and getting around the law and this, that, and the other. As Jim Eckley, our colleague who we've spoken at events with and will be speaking at the event that you're also at this coming Saturday, the East Coast Note Convention, Donna, you know, the conversation is why not do it right? Why not get maximum value for your note? You know, the discount and that you're subjecting your note to, if it's not done correctly, is massive. We actually know an individual that buys non-compliant notes, and the discount that he's buying them at would blow you away.
That's because no one else is doing it.
Yeah.
Well, here's something that's a more macroeconomic problem is with the fall of the real estate market, the crash in '08, the securitization market went away. And that's why banks are only Fannie and Freddie and FHFA are buying notes now, and they're federally backed. There's really not there's a void missing for notes to be purchased, and the banks are capitalizing on that, saying that, oh, your note's not compliant or your note's not this or that. We need to create our own marketplace for notes and bring back investments into, like what happened in the 80s with my grandmother when she bought a note from somebody or a second trust deed from somebody and she got a good return on her money. You know, we need to go back to the future or whatever you want to put on it, and we need to create that market for ourselves, not only for the people that are buying REOs and rehabbing them and selling them on seller financing. On the East Coast and the Northeast, your home values are $100,000, maybe, you know, at the most $200,000 for a good portion of those homes, and the banks aren't willing to do a $100,000 loan because it costs $6,000 to originate it and sell it to Fannie and Freddie, and it's cost prohibitive. So the void we need to fill and create a market for ourselves, and it's up to us to do that, and that's where I feel we're at with this right now.
I agree 100%. I think that you're creating some very safe deals that we otherwise would have turned away, but by using seller finance consultants, they now become Dodd-Frank compliant, and they offer exceptionally high rates of return, more so than other notes. And they're a perfect thing for someone to put in their IRA like your grandmother did, and that kind of thing. So I think it's really awesome. Can we talk a little bit about some of the specific details? I'd like to go over, I mentioned the REOs and the people who are in the business. I'd like to talk a minute about the real mom and pops that own their own house, and it's the only note they're ever going to create and sell in their life, you know. Do they need to be Dodd-Frank compliant?
No, that's your only true exemption. And what I mean by that is you have a lot of guys running around telling people to create multiple entities, basically you could just create a bunch of entities and that would give you exemptions. First of all, the exemption, the only true exemption if you're selling your own home and you can do it every 12 months, forwards or backwards, that's your only true exemption. If you're a real investor and you want a balloon, and you'll want a balloon if you want maximum resale value, you need an MLO. Period. It's as simple as that. And you know, we've seen people go in circles and circles and circles. Why not just embrace the fact that this is reality? And you know, whether you're doing a lease option, and you know, by the way, even if it $1 in consideration makes it a sale, which means it's now subject to Dodd-Frank. You know, pretty much any investment grade scenario is subject to Dodd-Frank, short of someone selling their own home. They can sell their own home to anyone, a consumer or a non-consumer, with a balloon, and they can do it on their own. But I mean, I think that gets into the second part of what we do, and that is consulting and packaging. Because you know, even if your transaction is not, you know, if you're a mom and pop and it's not subject to Dodd-Frank, you'll want a clean, good note, because you still might want to resell it, and you might want that flexibility that you and Terry and I know that, and anyone in the know that comes with owning a note. You can sell a part of it, all of it, and you know, certainly we don't need to talk about that, but you know, to maintain maximum flexibility and maximum investment grade value, you'll want to make sure you have good collateral file, all the disclosures. We're the only ones, as far as we know of, that have an MLO certificate that we will attach to the note package, which means that you'll have something that you can feel confident in carrying going forward.
I think that's awesome. I'm hoping that'll become a benchmark of the industry. Seriously. I mean, can you imagine how that would change things?
Yeah.
I want to digress just a minute here and clarify something, because you mentioned doing the different entities, and that, quite frankly, is something that I used to teach. That came from the S.A.F.E Act. When the S.A.F.E Act first came out, you could get around it with different entities. And what happened was, there were so many different versions because every state had their own S.A.F.E Act, and you didn't know, I mean, and just trying to interpret it when there was no case law to back it up. And so everybody was kind of guessing, if you will. This is my best guess, or my most intelligent guess at what's meant by this, but nobody really knew cut and dry,
Sure.
This is where we're at.
Sure.
But now that we have Dodd-Frank, I still think there's some ambiguity in it, but it's much, much more clear and defined than the old S.A.F.E Act. So for everybody listening, if you're hearing things and you go, wait a minute, Donna, you said this, or you know, so-and-so said that, that was before Dodd-Frank became fully effective. That's going back to the S.A.F.E Act. So you really do need to take the time and learn from folks like Terry and Mark and Jim Eckley, and learn what the Dodd-Frank Act really is all about. Mark, if we could go back to talking about the mom and pop,
Sure.
The only true exemption. Okay, so they're allowed to put a balloon on it. Does a mom and pop doing one note, do they need to check the credit worthiness of the borrower?
They get a free pass on pretty much everything. And that's, like Mark said, that's the only free pass. If you're a mom and pop and you're doing a second one or a third one, then it triggers a lot of other things, including no balloon. The note needs to be fully amortized. So the one true exemption is that. But what seller wouldn't want to know what their buyer's credit score is, or what their income is, or what, those are like common things if you're a mom and pop seller and that's your only asset, and you want to protect it. Just by natural questions, you would want to know that stuff. So even though it's exempt, really you still may want to do that as a mom and pop, and hire an MLO to do it. And your buyer is going to be the person that's going to pay that fee. In most cases, anybody that gets a loan, on a regular borrower has loan fees and all kinds of fees. And so why wouldn't in the case of seller financing, and this is where the paradigm shift is in the whole industry, is why in seller financing, historically, there has been no fees, or everything's put on the seller, that the seller will pay the fees or whatever. So why? Like, who said that was the best way to do things? If the buyer can't get their own loan and need the seller to carry back the loan, why shouldn't the buyer pay the fees? So,
Right, as in any other transaction.
Right, I agree with that. I totally agree. Well, since you brought up fees, can you give us an idea of how your fee structure is for you to give your blessing to a seller finance deal?
Sure, but before we do, I think it's important to clarify in terms of a lot of these people talking about title holding land trusts, or and forbearances and not doing forbearances correctly, and lease options, and setting up multiple entities. In our book we actually quote it right from the CFPB, and the CFPB is essentially God for all intents and purposes in terms of the finance sector. They control everything now, and everything goes and passes by their desk. The Dodd-Frank Act is essentially the equivalent of the Affordable Care Act, equivalent of the Homeland Security Act, and this is a reality we're living in. And if you're sitting here in denial, thinking it's going to get reversed, you can ride a dinosaur, or you can get with the times, and the fact is it's here and it's not going anywhere. The Affordable Care Act's been attacked something like 60 times. It's been the most unpopular act for whatever reasons. And I'm a registered independent. I'm not making a political comment one way or the other. But the reality of it is, if the Affordable Care Act's not going anywhere, the Dodd-Frank Act isn't going anywhere. And something that a lot of people like to argue is the Dodd-Frank Act was created by the banks, who control 2/3 of the GDP of this country. So I think you're really asking for trouble if you're asking to look for ways of getting around it. And if you are, it's be prepared for it maybe being Exhibit A against you, when you go to court. And the reference is substance over form. And any attempt to subvert the act, and it specifically says this in the Dodd-Frank Act, is a violation of the act in and of itself. And the act is fully modifiable, so expect modifications to come. Only 50% of it has actually been rolled out. So this is a monster that we're all dealing with, and all this time that we're spending trying to get around it, not us, of course, but we've embraced it, and most people in the know have embraced it. But why not just accept it as a reality and do what you do best, which is doing deals? We have a great solution here, and so anyways, that's all I really wanted to say on closing that loop on the whole getting around the act. There really isn't any.
I totally agree with you, Mark. This is a monster, and they have buttoned everything up so tight. It's not worth the trouble. And like we were talking about before, when you look at what they're requiring you to do, those are all things that make your note much more valuable.
Exactly.
And it makes it fair. It protects the consumer from the guys, the sharks that were out there trying to take advantage of people.
Yeah.
I think it hurts people like myself. It prohibits me from doing some deals that I would have done that would have been a win-win for everyone. But I think that protecting the people from all the bad guys is way more important than the few deals that it keeps me from doing. You know what I'm saying?
Yeah, really what the law does is it makes you disclose everything. So we're a third party that's neutral. We're not approving a loan. We're taking the information from the buyer and we're giving it to the seller to make a decision that's educated based on standard practices that banks make decisions on. And it doesn't mean that if we just did one that the debt to income ratio was 110%. I mean, that's 43% is in Dodd-Frank. The seller accepted it because in 2 years the buyer's going to be old enough to get a reverse mortgage on the property, and their debt to income they didn't even, no one cared about because it's just a stopgap arrangement until the reverse mortgage comes into play. So all we're doing is getting information and conveying it to the buyer and to the seller based on standard practices. And really, that's where the value is in what we do. And so, Mark, do you want to go ahead and go over the fees?
If I could just, if I could interrupt you. Terry, that's exactly the kind of thing I'm talking about, where there are valid exceptions. For example, like you mentioned, the 110% debt to income. So are you saying that you were able to sign off on that even though it didn't meet the Dodd-Frank guidelines?
Of course. That's where an MLO needs to be hired to we're not making that decision that the seller has. We're not denying that loan to the seller. So let's say let's give an example here. Let's say that you're an investor and you're selling to a homeowner, and this is your second deal. And so Dodd-Frank says you can do that deal if you're doing 2 or 3 per 12 months. And this is your second one, so you feel that you're exempt. Well, the Dodd-Frank Act says that if you're doing that, you don't need an MLO, but you have to have a fully amortizing loan. So in order to get around having a fully amortizing loan, you have to hire an MLO to be able to take the information from the borrower and give it to the seller. And then as an MLO, we have put the blessing on that as a third party and taken the responsibility to say, look, seller and Mr. Buyer, under Dodd-Frank, you need to have a fully amortizing loan. However, because you're intending on refinancing in 18 months because you turned 62, you understand that you have a balloon, and Dodd-Frank says that if you have an answer on the balloon, or if the borrower has the ability to either refinance because they've enhanced their credit, or like in this case a reverse mortgage, then the seller can accept that, but it needs an MLO to do it. Otherwise, it has to be fully amortizing.
And this is even, excuse me one second, this is even for a mom and pop that are selling their only house that they're ever going to sell?
No, that's the only
That's
example.
the one exclusion. This is for someone who's doing...
Hello?
Are you there?
Yeah, we lost you momentarily, Donna.
Okay,
Yeah.
sorry. Okay, I just wanted to clarify that for everyone, because I know that some people were probably wondering.
But who would know all these details? I mean, it's ridiculous. It's like Mark said, the Affordable Health Care Act. It's Obamacare. I mean, no one knows, even the doctors. They don't even know what they're doing.
I agree wholeheartedly. I absolutely agree. Mark, you had mentioned something, too, that I'd like to bring up, and that was with regard to forbearance agreements.
Sure.
Because a lot of people feel that if they own the note and that they can, when they're doing a workout, that they do not need a licensed MLO. Would you like to address that?
Sure. I think forbearances fit in the category, on the paper side of the real estate, that being the equivalent of lease options. If you take $1 in consideration, it's a sale, which means you need an MLO. With respect to forbearances, again, if you are modifying a note, and this again, a question always comes up, well, what if I'm buying paper? Well, if the paper was originated after January 10th of 2014, it's subject to the Act. Well, same thing here. If you're modifying a note in any way, shape, or form after January 10th, 2014, you are subject to the Act. Now, let's be specific. It does not mean that you necessarily need an MLO. However, you have to comply with other aspects of the Act. Again, just like Terry said, who would know all these things unless you want to read the 803 plus pages? Jim Eckley actually calls it 10,000 pages with all the addendums and whatnot. Have fun if that's your, if you're a masochist. We don't know too many other people who have read it other than Jim. But the point here is you have to comply with ability to repay, which, as Terry just mentioned, in doing the 110% loan that we did recently, we did not need to comply with the ability to repay. So the issue here again is not necessarily that you need an MLO, but it is subject to the Dodd-Frank Act.
Well, we did comply with the ability to repay. We just had an answer for the balloon.
Correct.
which was what needed to happen in that transaction.
Correct. And we have a limited service, highly discounted fee, and you want to talk about fees, so that's probably a good segue. That
Okay.
that is an answer and a solution for forbearances where they don't need a full MLO.
We lost you, Mark.
Okay. How about now? Hello?
I can hear you. I can hear you.
Okay. So we have an answer and a solution for forbearance agreements where they don't need an MLO, but they need to comply with the other versions of the Act. It's a limited service, highly discounted fee that we'll probably be rolling out. Our book is our book and the next two conventions we're speaking at is our focus right now, but probably for February we'll be rolling that out, and that's for people that need facilitation of their forbearances. In terms of our full MLO service, which includes consulting, includes helping them put their deal together, all the basic things that and even if you're not subject to Dodd-Frank, most people and most attorneys are going to tell you that you still need an MLO because, as Terry mentioned, why wouldn't you want to know the credit? Why wouldn't you want the income? Why wouldn't you want the borrower qualified? Why wouldn't you want your disclosures? Why wouldn't you want a note that has all the collateral file there? So that being said, our fees are $19.99. The greater of that or 1% of the value of the transaction. Most of the clients that we work with will bury it into the purchase price and then give the buyer a credit back, so that so that basically there's it's essentially buried into the transaction. Most buyers don't have a problem paying for it because it's their only way to get in the door. If you really want to pay it as a seller, I guess you could. I don't know why you would, but because as you know, Donna, when you do seller financing, that's the best upgrade you can put in a house. We sold off a house that needed $100,000 worth of repairs for full value earlier this year. There's a case study on it on our YouTube channel. But you can upgrade a house all you want, but right now when 2 out of 3 people don't qualify for financing, you're in the driver's seat as a seller. And by providing seller financing, it's the best upgrade that you can put into a house. And we wouldn't be behind this business model if we didn't believe otherwise.
I agree, especially like for the people that I was talking about before who buy a package of REOs and they've bought them for pennies on the dollar.
Sure.
$19.99 it's nothing. I don't mean it like that, but it's very affordable and very, very worthwhile.
Yeah.
The protection that it offers, and just enabling them to be able to sell that note for cash. It makes it all worthwhile. Now, what is your fee for forbearance agreements if you're helping with that?
We'll put that out on our. We don't know yet because we don't have a standardized process for that yet. We will in the next 2 weeks or so. Our book has been kind of been our focus, and then now we got 2 big conventions. If you guys are listening to this and you're coming to the East Coast convention, Donna's speaking there as well. You should definitely come out and check it out. It's the first annual. Nick Tang has put together a great convention, and he's a great guy, and you'll get a lot out of it. It's in the New Jersey area. And then we'll also be speaking at the Los Angeles Creative Real Estate Association convention or meeting next month, I think on February 10th. So we'll have that out to make.
It's probably going to be an hourly fee because everyone's going to be different.
Yeah.
I would think.
Yeah, probably a consulting fee.
And then will you do something similar for the existing seller finance notes, the mom and pops who sell one note? If somebody wants you to give them a certificate on an existing note that they're buying. Yeah,
that's going to be additional. The law is just so new, and we're learning as we go as well. We've been concentrating on the origination side of it, but I know there's going to be people coming back and saying, hey, we did it this way and we know it's wrong now, and we can only get half of the value from our note. Can you fix it? And client, and that's something that hasn't even hit us yet, but I know it will. because there's so many people that are ignoring it, and they're going to come back after the fact and want it fixed.
Well, I agree. And one of the biggest things is what we had been talking about previously. I don't think we've mentioned it on the call, but about the ruling about after January 10th and the disclosure. Do you want to talk about that? That's an important thing. If we're buying an existing note, even if it is the mom and pop, they lived in the house, it's the only note they've ever done, there still should be a disclosure if that note was originated after January 10th. Terry, you want to talk about that?
Well, so Jim Eckley, attorney Jim Eckley, who we've been talking to, I feel like he's my mentor for the last 3.5 years. He created a form that can be used in any transaction. That it's basically a form. Let me back up. The Dodd-Frank Act requires, except for Tennessee, it requires a MLO for any buyer that is a homeowner occupant. So in a transaction, if there's a seller that's going to finance to a person, let's say, and so the question is, are you a homeowner or are you an investor as the buyer? And the buyer could turn around and say, you know what, I'm an investor, wink, wink. And then they turn around and two or 3 years later, they moved into the house and they occupy it, and they come back to the seller and they say, you know what, Mr. Seller, I'm an owner occupant and I'm suing you because you didn't follow Dodd-Frank. Well, Jim Eckley created a form that the buyer has to sign whether they're an investor or they're a homeowner occupant, and it basically discloses what Dodd-Frank is, what it's what it's supposed to do, and it makes that buyer sign and commit to who they are. Are they an investor or are they a consumer? And it's just very simple, and it distinguishes the relationship between the buyer and the seller. And we gave it to us, and we're offering it for free. And Donna, I believe you have it as well now.
I do, and you're right. It's very simple but very effective.
Yeah, it's on our website at sellerfinanceconsultants.com. If any of your subscribers want to go ahead and download it.
It's probably the most valuable 4 or 5 sheets of paper that you could have if you're going to do this. And it's, the other thing is it's free, which is amazing. And that really sets up, because as a mom and pop, let's say you carry that loan and then you want to sell the note or borrow against it sometime in the future, and you are exempt, but how do you prove that you're exempt when you're trying to borrow against that note or sell it? And so if you can't prove it, what investor is going to take the chance or take your word for it? And that proof has to come from the buyer. And so you can very easily solve all those problems that are going to happen in the future with this one form.
I totally agree. I think it's awesome.
And the other thing, it's the first form that, it's your point of contact form, because a lot of people will contact us and say, well, what do I do? What do I do? Where do I begin? Well, there you go. That's where you begin. That's the first that's the first disclosure that we use of all the other disclosures that we do use.
Okay. I'm going to catch you completely off guard because we didn't discuss this previously, but for my clients who would like to use your services, is there something special you can do for them? Can you offer them any kind of discount, any kind of reports, or anything special for my people?
The problem is federal law with respect to the Dodd-Frank Act. We can't do anything special with respect to, our fees have to be uniform. What we charge A has to be charged to B. We could certainly do consulting and we usually give 15 minutes free consulting for a first contact. For your clients, we'd be happy to allow it to go to a full 30 minutes and give them some bonus time. They can schedule with us. We have an online scheduler on our website if they want to schedule a talk with us. And, after the 15 minutes, we charge a fee for consulting, but we'll give them, basically a full 30 minutes. And, we're not sticklers of time like a psychiatrist or or an attorney where, if it goes over by a bit, that's fine. So
You don't charge in 4.5-minute increments or anything like
No. Yeah, that's real important though, Donna, is the federal law and lenders that are listening out there that do regular loans. You can no longer, charge one person a half a point and another one a full point and another one something else. And you can't even do credits, during the transaction just to keep it alive. It's a set fee and it can't be changed. And the same thing applies with seller financing.
In what way with seller financing?
Pardon me?
Can you expound on how it applies to seller financing?
Well, the 1995 fee.
Fee too. I thought you meant as someone originating a seller finance note.
Whoever originates that note, like you might find somebody in Ohio that charges, 1% and plus $500 or something. That they have to charge that for everybody. So.
Okay. But you're talking about an MLO. You're not talking about the seller of the home and the holder of the note.
Absolutely.
Correct.
Okay. Just to clarify that. Well, Mark, thank you for your offer for the extra 15 minutes of consultation. I know my people will really appreciate that. So how can they contact you? They go to your website, or what should they do?
Yeah, they go to our website, and they need to obviously let us know that they came to us via Donna Bauer, and that's really that. We'll send out this recording, and they can listen to it. Obviously, this is not done live, so they're going to listen to it recorded. Listen to it again. You might pick up a gem or nugget. And Terry, you got anything?
No, but I look forward to working with you this weekend and having some conversations on how we can really roll this out nationally. It's something that's important and needs to happen, and if we don't do it, someone else will. So we might as well jump on and move forward.
Absolutely, I totally agree, and I'm looking forward to it too. Mark, is there a place on the site that they can put down that they're a client of mine?
Yeah, when they schedule it, we have an online scheduler in the bottom right-hand corner of the site. They just are going to put a note in there, and some people like to schedule. Some people send us interviews. We've been getting absolutely bombarded lately, so we get people that want us to do like email consulting where they just keep asking us questions. Unless they're a client of ours, we don't answer questions without scheduling through our scheduler. Once you become a client of, and once you become a client of us, that's kind of a benefit, is you can randomly ask us questions. We're not going to charge you, and of course that could change a year from now, because as far as we know, we're the only ones offering this service. But for right now, that's kind of what we've agreed upon. That you schedule through our online scheduler. You can put a note in it that you came via Donna Bauer, and you can get some extra time with us, and we'll go from here.
That is awesome. Before we close, is there anything else that you feel that is important for people to know about Dodd-Frank or seller financing? Is there anything I overlooked?
Two out of three transactions now are private transactions. We have 76.5 million baby boomers, 90% of which have all of their net worth in home equity. So, in terms of a blue ocean strategy, I don't know if you're familiar with the book, but I mean, this is bigger than a niche. It's a demographic shift. We coined the term the new shift in real estate finance, because we really think we're going back to the 80s, where seller financing, we jokingly say is not not carry out at your local Chinese steakout. I mean, this is a very real strategy, and it provides meaning. You can, unless people know something we don't know, you can't just go cook up, peel some shingles off your roof and cook them up for dinner. And death is not a retirement plan. So people need seller financing, and this is a means to be able to do more transactions. And if you embrace it, these are going to be some of the best years of your career. And do it right. It's not worth risking your license or your career if you're unlicensed, or certainly your investment on trying to do some shady let's get around this federal law monster. I mean, it's just not worth it. The buyer pays the fee, so why wouldn't how much free insurance would you like to have? We're here for that purpose.
I agree 100%. Well, I want to thank you both for taking time to do this call. I am really looking forward to seeing you this weekend. And I want to tell everybody you can go to, it's Seller Finance Consultants with an S, correct?
Yeah, plural.
.com. sellerfinanceconsultants.com. And check them out. If you are originating any seller finance notes, I highly, highly encourage you to use them. And then as you get your plan together for dealing with existing seller carrybacks, we'll have another recording and get another webinar or a conference call out to address that. But it's exciting to be on the cutting edge and to be a part of this new rollout. I think it's phenomenal. It's needed so much, and I'm just looking forward to offering this to my people.
Thanks, Donna, for having us.
Yeah, our pleasure.
And thank you all for joining us. I hope you enjoyed the recording, and be blessed. Have a great day. Thank you.
Okay.